All right, everyone. Want to welcome everyone to Legacy Wednesdays, Fire Through Real Estate. Today's topic is how to get into your first passive real estate investment. So, if you're joining us here today, we have lots of people registered, lots of people here, still got some people coming in. You're interested in getting into commercial real estate as a passive investor, but you're not quite sure where to start. This webinar is for you. So, if it's your first time here, I want to say welcome. We host these webinars every Wednesday, 2 p.m. Central, 3 p.m. Eastern on Wednesdays, and our goal is to help you achieve FIRE, which is financial independence, retire early through real estate. So, real estate is a great investment vehicle. A lot of people aren't educated and don't know enough about how to be a real estate investor or how to be specifically a passive commercial real estate investor. So this webinar series was designed for you. So let's dive in. Let's get started. All right, just a quick disclaimer. This webinar is for educational purposes only. It's not investment advice, and it does not represent any offers to sell any type of securities. Obviously, we always want to guide everyone with some educational content, but it's on you to consult your own attorney, consult your CPA, consult your tax advisor before you make any type of investment decision. What is FIRE? Kind of covered this here a minute ago, but FIRE is it's a big movement in the financial space. It's financial independence, retire early. So it's for professionals who have built some momentum in their career. Maybe you're an IT professional, maybe you're a healthcare professional, maybe you're an attorney, you're a doctor, you're some sort of well-compensated W-2 employee, and you want to achieve financial independence early. And what does that mean? That means you do not want to work until you're 65. And if you do want to work until you're 65, you want to make sure that you retire comfortably, that you've got cash flow coming in, that you've got equity on your balance sheet, that you are in a good position to sort of sail off into the sunset and enjoy your life for the remainder of your years, however long that may be, right? So your goal is to achieve financial independence, and we believe that one of the best ways to do that is to include commercial real estate in your portfolio. It's going to provide you with all kinds of benefits. So we're going to dive more into financial independence throughout this webinar series, but that's our purpose. That's what FIRE is. We'll talk a little bit about who we are here at Headway Capital. Again, if it's your first time here joining us, I want to say welcome. Thanks for tuning in. I really appreciate your attendance, and hopefully we're able to add a lot of value to you. Headway Capital was designed to build and protect the wealth of busy professionals. We provide exclusive private investment opportunities that help give you the freedom to take back that time and do what matters most, right? Our team has experience sourcing, vetting different types of investment vehicles into commercial real estate space, with an exclusive focus, at least when we got started, on multifamily real estate. So our principal, our founder, is Sid Shamim, and him and his wife, Anam Omer, they started Headway Capital back in late 2017, 2018, after acquiring a pretty sizable residential real estate portfolio. So we've got lots of people here on this webinar today. And I believe there's a really good chance that a lot of people on this webinar are single-family real estate investors, or residential real estate investors. Well, I'm here to tell you that that's how we all got started. So Sid and Anam, they got a pretty sizable portfolio. They got a little bit over 30 houses before they quickly realized that it became a lot to manage. And if they were going to build any true wealth and they were going to able to enjoy the fruits of their labor, they knew commercial real estate was the way. So they started investing passively first as passive investors into other people's projects, other people's private investments, and eventually graduated to exiting their single family, selling their residential portfolio, and scaling into multifamily commercial real estate in 2018. And I guess you can say the rest is history. That's the same year that we started Headway Properties, which is our vertical arm of Headway Capital. That's a property management company we use here to manage our assets based in Houston, Texas. We have a great team over at Headway Properties, a little over 50 employees. That we're super proud of, and they're out there busting their butts every day to make sure our investors get paid and make sure our residents are super happy. So that's a little bit about Sid and Anam. Anam is a full-time GI. She is a healthcare professional by trade, and really her value is and her passion is outside of her healthcare practice, just sharing this knowledge with other high-income professionals, other healthcare professionals. We have over 400 investors, and a lot of them are healthcare professionals that Anam has been able to educate, which is just amazing. And then a little bit about me real quick. I won't take too long, but my name is Brian. I'm the Director of Investor Relations here at Headway Capital. As I mentioned, I got started in real estate in 2018 just by buying single family houses. I was following the BRRRR method, which if you're familiar is buy, rehab, a rent, refinance, and repeat, right? So just recycling that cash essentially. I very quickly realized after a handful of houses, residential real estate was not my foray. Wasn't my thing that I enjoyed doing the most. I was making some cash flow. Obviously, had a little bit of a balance sheet there, net worth increase, but it wasn't building the momentum that I thought it would. So late 2019, early 2020, I transitioned over to commercial real estate with an exclusive focus on multifamily as well. Got some education, found some mentors, worked at a small boutique private equity firm for about 2.5 years before I transitioned over to Headway Capital. And I joined Sid and Anam, and here we are to this day. A little bit about our firm. We have a little over $539 million of assets under management, which equates to a little over 3,000 units. Our buy box, what we're really looking for is to find value add multifamily investment opportunities that are going to provide that 7 to 10% target preferred return. And our goal is always to double our investors' money in 3 to 5 years. So the way we do that is by seeking investment opportunities that provide solid returns in the 20 to 30% range. So 25 sort of being our baseline where we like to be. But if we can aim higher, we always do. We want to provide our investors with great returns. Now, how we produce results, what's our secret sauce here at Headway? These 4 things really make up the bread and butter of Headway. One, we're really focused. We stay focused on acquiring great deals and managing them well. We stay really focused on educating our investors. We do this webinar series every week, and we stay really focused on operations. We want to make sure our residents are as happy as we can be. A lot of the properties that we're managing and we own are workforce housing, meaning we're dealing with residents that haven't always had a great place to live. So we try to manage those properties very tightly and provide them a great place to live while also keeping the reins really tight and making sure we're having quality residents that pay their rent and pay their rent on time. We're also purposeful with all the work that we do. We make sure we have good intentions. We stay disciplined and we stay consistent, right? So we're very disciplined in our investment strategy, very disciplined in our approach. We think very hard before we make decisions, especially if they impact our investors. And we know that over a long period of time, if we take this recipe of being focused, purposeful, and disciplined, and we're consistent over a long period of time, this is how Headway Capital is going to continue to produce the results that we've already been producing now for over 5 years. All right. So last thing about Headway is we provide passive investing opportunities, private passive investing opportunities to all of our investors that are on our what we call our Preferred Investors Club. So if you're not a member of our Preferred Investors Club, you're not going to see these opportunities. So it's definitely important to get in contact with us. But these are really our bread and butter: apartments, service businesses. So we own a couple of service businesses that take care of our assets. A construction company and is one of them. We also have a real estate debt fund that we launched about a week ago, and it's about to open up for investment. We've had so many interested in parties. It's been great talking about the debt fund. And then the last one is we source private investments in the car wash space as well for our investors. We had an investment offering in June and July that we were closed up. It was a portfolio of 8 car washes, which is really exciting. And we're hoping to announce some more car washes here soon. All right, let's dive right into the meat and potatoes. Why are you here today? The big question looming on your mind is how can you get into your first passive real estate investment, right? So I want to cover 4 things today. And my goal is to keep this webinar short and sweet. Everybody's time is super valuable. We'll definitely leave some time at the end for Q&A. So if you have any questions, put them in the Q&A box. I'll make sure I do my best to get to as many of them as I possibly can. So what we're going to cover today is first of all, how to pick an asset class. And if you're not sure what an asset class is or what the options are, we're going to go over that today. I'm not going to cover all of them because there are far too many to talk about today, but we're going to go over some of the basics, high-level ones. We're going to talk about the pros and cons, or what I like to call risks and rewards of investing in each one of those asset classes. We're going to talk about how to build your investing team, right? Anytime you're investing in commercial real estate, you always have to have a team, whether you're a passive investor or you're sitting in my seat as an active investor. You have to have a team, and your team makes or breaks a lot of these projects. How to gain access to these opportunities. So once you pick your asset class and you have your team ready, how do you gain access? How do you start seeing these deals? Where do they come from? It's not as easy as going on the internet and going to a website and necessarily finding them. There are some places you can do that, like crowdfunding websites, but how do you get access to these private investment opportunities? And then the last one is, how do you quickly say yes or no when it comes to an investment opportunity? We can spend hours going over how to analyze a deal in detail, but I want you to leave this webinar being able to quickly say yes, or I'm interested, now I need to dive deeper, or quickly say no, this opportunity is not for me. You got to be able to make quick yes or no decisions in the private investment space. And part of the reason is these opportunities can fill up very quickly depending on the size of the deal. If it's a smaller deal and the equity capital raise is only a few $1,000,000, it's not uncommon that these things are filled up in 24 hours or 36 hours or 48 hours very quickly. If it's a larger deal and it's maybe a 20 or $30 million deal, you're definitely going to have less than 30 days, usually 2 to 3 weeks, kind of being the average. So you don't want to sit on it, right? When one of these deals comes out, you got to be able to say yes or no very quickly. So that's our goal for today. So let's dive right in. How do you pick an asset class? And I wanted to make sure I highlight this point before we jump into these 5 asset classes that we are going to talk about today. Different assets have different risk and reward profiles, and that's really important to know. A lot of people umbrella real estate and they say, oh, you're a real estate investor. Well, what does that mean? And then they also don't understand that every asset class has different risks and it has different rewards, which is why, to me, it's always really important that you align yourself with an asset class that meets your goals, right? So you have to know what are your goals? Where are you at in life? How old are you? How much cash can you invest? How long is it until you get to your retirement? What do you need to do to today to accomplish your retirement goal between your private real estate investment portfolio, between your 401k, between your IRA, between your ETFs, between your index funds, your stocks, all this stuff? How do you manage all these portfolios, and what do you need? Which asset class aligns with your strategy based on where you're at today and where you want to go? Right. So let's talk about each one of these. Let's dive in. We're going to go a little deeper and kind of cover high level. What are the risk and reward with each asset classes? So we're going to start off with multifamily. So if you don't know what that term means, multifamily just means apartment complexes. So you'll see a picture here on your right-hand side. That's of one of our assets. That's a multifamily asset. That's an apartment complex, right? Usually multifamily, in order to get that designation, has to have more than one unit, right? So it's little as 2 units. But it can go to be commercial, it needs to be 5 units or more. So it's not designated as commercial multifamily unless you have 5 units or more. So 2, 3, and 4 units is residential multifamily, which is not what we do here at Headway. And commercial multifamily is 5, as many as you can build, right? So typically, what I would say from a risk mitigation standpoint, you're typically going to want to try to invest in slightly larger projects. More doors diversifies risk. So that could be as little as 20 or 30 units, but ideally in our wheelhouse, and what we like to touch is we like to touch things that are 100 units or more. It's going to really mitigate that risk and give us more opportunity for value add and upside as well. It's going to make our dollars stretch much further. So let's talk about some of the risks and the rewards of multifamily. So first risk I have on here is economic downturns can impact residents, right? So that just means that we are providing housing. And if we are providing housing to C-class properties and B-class properties, these are typically blue-collar, middle-class residents. And if there is a recession or there's a lot of unemployment or there's something that goes bad in the economy and a lot of jobs get lost, that can impact your residents because we are providing housing. So there's always the risk that you can see what we call an increase in delinquency, meaning residents are paying their rent late. You can see an increase in late fees, which isn't always a bad thing because late fees can mean more money, but when you're not collecting the rent fees, that's a problem. And you see a decrease in your collections, right? You're having a hard time collecting rent during economic downturns. So that's always a risk. Second, it's very competitive. So that means that on our side in the investment space, it is a very competitive landscape. So what does competition mean? Competition means higher pricing. Multifamily, I would argue, has been the golden child of commercial real estate, specifically for the last at least 5 years, but really the last since 2020 coming out of COVID. Multifamily just exploded. Maybe you're on this webinar because you love multifamily or you've invested in multifamily or you've heard about multifamily and how great it can be. Well, it is a great asset class for a variety of reasons we'll talk about here in a second. But the amount of eyes that I've looked on commercial real estate and multifamily in particular, specifically with large institutional capital, such as the BlackRocks of the world, has made pricing drive up, significantly. And the sellers and the owners of the multifamily assets know it. So it's super competitive. So it is hard to find a good deal. The third thing I want to highlight is there are property management challenges, which is always a risk. So that just means that there are challenges when it comes to managing these assets. It's not as easy as it sounds. You don't just buy the deal, hire a manager, and sell off into the sunset. Have a great day. There's a lot of hands-on work that gets involved on the asset management side. If you're using a third-party property manager, meaning you're hiring a manager to manage the asset, you're hiring a third-party company. There's a lot of risk involved with that company. Do you know that company? What's their track record? Do they have the right team in place? Are they the right manager for the right asset? And can you hold them accountable is really the really big question. Can the sponsor hold them accountable? Well, Here at Headway, we're actually vertical. We own our own property management company, but there's still risk involved, right? Because you have to deal with staffing, you have to deal with turnover and different things of that nature. So property management is definitely a challenge when it comes to multifamily, which is why it's really important that if you're investing in a multifamily deal, that you find out who the property management company is that the sponsor plans on using. Is it a third-party manager? If it is, that's okay, but you got to make sure they're a credible company, they have a track record, and they have a reputation of operating in that market. Let's talk a little bit about the rewards. So one, potential for stable cash flow. Multifamily can be a great cash flowing vehicle. It can sometimes take time to generate that cash flow. Now, because it's been so competitive the last few years, it isn't always one of the assets I would say today that throws off immediate cash flow. It can, they're out there. But more or less, usually the type of opportunities we're going to find trickle a little cash flow year one. You might get a 2 or 3% year one, and then it ramps itself up as we're doing our value add, as we're renovating units, as we're kicking out bad tenants, as we're raising rents and improving the market value of the property. That's really where you start to get that stable cash flow. So it's a great cash flowing asset once the business plan is on its way. Economies of scale is another huge one for multifamily. It's much easier to buy a 100-unit property and really enjoy the benefits, the cash flow, the tax benefits, the appreciation, the equity upside from a larger asset than it is of a smaller asset like a single-family house that's very segregated or very separated. You might have 10 houses on one side of the city. You might have another 3 over here, another 2 over there. It's really hard to get economies of scale. And then it has economies of scales when it comes to the materials as well, right? Flooring, carpet, paint, things like that. You're buying it in bulk because you're doing 100 units. That's a lot of value. Demand, multifamily has a tremendous amount of demand, and I'm not just talking about from investors. Unfortunately, as we all seen in the headlines, housing has gotten very expensive in almost all parts of the country. It's becoming very hard for the average person, especially out of college or the young person starting a family in their late 20s, early 30s, to really go out there and finance a house. Interest rates are high. Prices are high. Sellers aren't selling. So you have low inventory, high interest rates, right? It's not a good combination to be in. So it's really hard to buy right now unless you have a lot of cash in the bank and great credit, which isn't always a first-time home buyer, right? Most people execute FHA programs, 3.5% down, or they do conventional, go 5% down, 10% down. So it's really hard to buy a house now when your monthly mortgage payment might be $2,400, $2,500 or more. So there's a massive gap in the rent prices versus owning prices. There's a huge gap there. So you can live in a really nice 2-bedroom apartment for $1,400, or you can go buy a 3-bedroom house and spend $2,500, right? That's a huge gap that a lot of people can't afford. So the demand for multifamily is still really high. And then the last one is depreciation. So these assets, we execute what's called cost segregation studies. So we're going to accelerate depreciation on the assets so they can provide great tax benefits. And we'll talk more about taxes and CPAs and stuff towards the end of the slide deck, but they provide that as well. Car washes, let's run through that. So car washes have some risks, of course. They can be impacted by weather. So if it's raining for 30 days of the month, you're gonna wash less cars, right? So there is some ebb and flow. It's important to invest into car washes that are in a market that don't have a ton of rain every day. So you're looking at Pacific Northwest, a place that rains very often. You can argue that's maybe good or bad for car washes, but you want to invest in a southern climate typically for car washes that aren't as impacted by weather. Equipment and maintenance, very expensive, which is part of the reason that the car washes that we typically source newer car washes. We like to look at car washes that are 2019 to 2020 on up. We don't like buying 1990s car washes that need several $1 million in construction or CapEx. Of course, they can be bought at a discount and the numbers still might make sense, but we really like buying newer car washes so we don't have to deal with expensive equipment and maintenance costs. The stuff's, a lot of it's still under warranty or it's very new, very updated, very modern technology. And then the last risk involved with car washes is competition. Car washes are popping up all over the United States. It's becoming a very attractive asset class. New investors are hopping in the car wash space every day. There's car wash franchises. There's single car washes. There's chains of car washes, right? We all know like the Mr. Car Washes and things of that nature. So it's competitive. So it's important that you buy really good real estate in a really great area. You don't want to buy a car wash in a bad area because it won't do very well because it's not going to make any money, right? So, but car washes have great rewards, right? So they're great for cash flow. They really sell the subscription model, and that's what provides stability in the cash flow. The one-off car washes are great, but you're really trying to sell those memberships. And if you're buying car washes in middle-class areas, upper middle-class areas, selling those memberships is really your bread and butter. The third thing is just like multifamily. you're getting depreciation on the building and you're getting depreciation on the equipment. So multifamily has great tax benefits to the depreciation as well, and so do car washes, right? So it's just another cherry on top, as I like to say, in your investment. You're getting that cash flow, you're getting that equity upside, and oh, by the way, there's some tax benefits along the way, which is case by case depending on the investment and the investor. You have to ask your CPA, but there are some opportunities for great tax benefits as well. Self-storage is another asset class, not one that we're particularly exposed to ourselves over here at Headway, but I have some knowledge and have some good friends in the self-storage space. And risks involved with self-storage are, one, there's oversaturation in some markets. I can tell you here in Houston, there's self-storage everywhere. I feel like there's one on every corner, at least in my neighborhood in the suburbs. I see self-storage everywhere and they're popping up like crazy, right? So it's not necessarily a bad thing. So the competition keeps you on your toes and makes you a good thing, but you have to be really careful. Ideally, you're buying in a market and you're buying some sort of not exclusivity, but you want to lower the risk of competition. So if you can buy existing self-storage that has been owned for a long time by, say, like a mom and pop owner in an area that's very hard to build new self-storage, that's really the bread and butter, right? It makes a lot of sense. Or if you can do new construction self-storage and be in a great area, you need to get in and get out or continue to operate. Those are great plays as well. But there's a risk of oversaturation. Same thing with car washes, right? Economic downturn equals demand cut. So, self-storage, the leases are often month to month. So if somebody's spending, say, $100 a month on a self-storage unit and they lose their job or things get really tight, well, that's one of the things that they cut, right? If they take their junk out of there, if they can, or if they find a way to store it at their house, and they cut those types of expenses, right? So you might see a demand cut if there's a recession. And then there's security issues, right? Just operationally, I'm not a self-storage operator, but you have to be very aware of the security involved with protecting other people's goods, right? So you've got insurance, you got to make sure you have cameras, you got to make sure you have locks, you got to make sure you have keypads and different thof that nature to make sure you're protecting people. Otherwise, you run the risk of being liable for other people's product, and we don't want that. Rewards. One of the reasons I love self-storage, I have not invested in it, but it's on my list of things to look into, is low maintenance costs. It's just, there's some refrigerated self-storage, but a lot of these are just metal buildings. And there's low maintenance costs. There's no, not a lot of landscaping, not a lot of other things that you deal with that comes with like multifamily, for example. Same thing with car washes. A lot of equipment that needs to be maintained. You're not going to have that issue in self-storage. Steady cash flow potential, again, is if you're highly occupied and you're able to quickly adjust those rents, you're going to have great cash flow from self-storage. And that's the beautiful thing about them as well. Unlike multifamily apartments that have 12-month leases, these leases can change very quickly. They're month to month for self-storage. So you get the opportunity to adjust to market rate. So they've got software and they've got algorithms that can constantly for you adjust the rate of your units, so that when somebody's coming in to sign a new self-storage unit, it could be different today than it was yesterday because the software is doing an algorithm based on demand or where the market's at, right? So you can quickly adjust rents, which is a little different than multifamily. We have a 12-month window. And then you have low turnover costs. Multifamily is very expensive because of the make-readies, right? So somebody moves out, let's say they've lived there a year, 2 years, maybe even 3 years. You've got to change carpet potentially. You probably have to do drywall repairs. You probably have to paint. You might have to do resurfacing of countertops. There's all kinds of things that could get done depending on how they took care of that unit, that apartment home. You're not going to really have those issues in self-storage, right? You're going to just sweep the unit out, make sure the lock is good to go. And as long as they didn't do any damage to the walls inside, you should be good to go, ready to flip that unit very quickly. Low turnover costs is a big plus in self-storage. Let's talk about flex and industrial. Flex and industrial, these are industrial buildings that you see on the side of the building that do Amazon warehouses and things like that. But we're not necessarily talking about those massive 1 million square foot, 500,000 square feet type buildings. We're talking about the smaller ones. Think 200, 250,000 or smaller, that really provide great spaces for small businesses and medium-sized businesses that are looking for a place to call home for their manufacturing, or looking for a place for distribution, or looking for a place that's what's called flex, which is half office or part office, and then also warehousing or manufacturing in the back. So you get 2 in 1. You get your office in the front of the building, and then the rest of the building is used for manufacturing or for storage or distribution. So these have gotten really popular since COVID. So let's talk a little bit about these. Some risk involved with these industrial spaces is they are dependent on the economy. And I will say that has to do with the businesses inside of them, right? So if you have a company that rents space from your industrial building that you own, well, that company could go under. because of the economy, right? So if they can't pay their rent and they can't make money, that puts you at risk of having a tenant that can't pay their rent and are often renting tens of thousands, if not hundreds of thousands of square feet. That's a huge risk, right? They have longer tenant turnover times and long periods of vacancy. So what that means is that when it's time to turn a unit or to turn a space, it can be much longer. So a multifamily, an apartment deal or even a self-storage deal, if somebody leaves that unit, you can get it turned usually pretty quickly. In multifamily, we aim for 3 to 5 days. Self-storage is obviously much quicker, but it can be extremely long. It could be much longer than that in the industrial space. You're talking 30 days or more, just depending on what type of setup they have. And if you might also have to go in there and do some improvements and spend some dollars to get it ready for the next person, depending on the situation and what you're offering, right? And they also have longer periods of vacancy. It depends on your market. I will say that, which is why the market is super important. We're going to talk about that here at the end. But you can have long periods of vacancy. It's not uncommon that a space, let's say you've got 20,000 square feet in one of your industrial spaces, it could be on the market for 3 months. It could be on the market for 6 months. It could be on the market for a year, right? So it's really important that you understand, and when you're looking at these deals, that there's some risk involved in vacancy when it comes to these industrial buildings. Rewards. Now there's some big rewards when it comes to industrial, and I'm a big fan of industrial. Longer leases, steady income. So industrial tenants do not sign usually 1-year leases, right? So typically they're going to sign multi-year leases with 3 sort of being the norm. It could be 5. There's some longer as well, but 3 to 5 being the norm. That's a great thing because these leases that they sign provide long-term stability. So if you put a great tenant inside of your industrial building and they sign a 3 or 5 year lease, well, that gives you a lot of security. And there's pros and cons with that, but it's mostly a pro, in my opinion, that you're getting that security. You have a great tenant in there. They're also triple net leases. It's very common that the leases that are executed for these industrial buildings are triple net. And all that means is that a lot of the expenses get passed along to the tenant, which is great if you're an investor, great if you're a landlord. The property taxes, the property insurance, the upkeep, all that stuff gets passed on to the tenant through triple net, right? Through the CAM. So that's a great thing. As a landlord, you don't have a lot of expenses once you close on the property. Now, there's still CapEx and things that you do to take care of it, roofing, potential HVAC, parking lots. Those are a big part of it as well. Lighting, those things are still important to you as a landlord, but a lot of the other things get covered by the tenant, which is awesome. There's a growing demand in these since COVID. So I will tell you that I know people in the space and have participated in some projects in the space. And the demand for spaces, especially under 100,000 square feet, is sky high in a lot of markets. There's a ton of demand for small industrial space or small industrial flex space. And this is because there's such a limited supply of new construction, small to medium-sized spaces. Everybody that's building industrial right now wants to build the mega complexes because they get the Amazons and the big boxes to come in there and to buy the whole thing or to take up a significant amount of square footage. Well, those are attractive investments too, but I'm telling you, there's a niche or a demand for small to medium-sized industrial or flex industrial spaces. I can tell you here in Houston, we've got our construction company that we own here at Headway, and we've looked at moving spaces a couple of times from some of our current offices, and a lot of times we just end up staying because we can't find anything that is, to our square foot requirement and provides both office and storage. And that is actually in a good accessible area. And then finally is actually affordable, right? So the demand is through the roof. When things hit the market, they often get scooped up very quick, which again is market specific, but I will tell you a lot of great markets have a lot of demand for industrial and flex. Mobile home parks for the last one. I'm not very experienced with mobile home parks. Again, I know some people in the space, but they are another asset class. And there's some risk involved with mobile home parks. Is one, they have a bad stigma, sorry. They're just looked at as a negative asset, right? People think mobile home parks and they don't usually think good thoughts. So there's that negative stigma that comes along with investing in a mobile home park, good or bad. They have a lot of a risk when it comes to natural disasters, hurricanes and different things that come to the south, tornadoes. These things are typically located in very rural places. So there are some risk of natural disasters. They don't have the fancy drainage and different things that a lot of major cities where you have multifamily or car washes or self-storage or industrial buildings are going to have. So you got to be careful with those types of things. There are also the risk of investing in a mobile home park that has what are called park-owned homes. Personally, I would not invest into a project where the plan is for the operator or the partners or the investors to own the homes. There's much more risk in cash involved with doing that. And the best strategies that I've seen in the projects that I've looked at that have been very attractive are where the owners of the mobile home park actually don't own the actual mobile homes. You want your tenants, your residents, to own the homes. There's several strategies where you actually sell them for almost pennies on the dollar as soon as you acquire it, just because you don't want to be the one who has to take care of it. There's a lot of CapEx involved with maintaining these homes. So in my opinion, there's a risk involved if you're investing in a project where the park owns the homes. I try to avoid that. And then there's regulatory challenges. Municipalities and cities do not like mobile home parks, period. So you got to definitely make sure you're investing in a city that isn't, coming down on the mobile home park industry, so to speak, and making it harder to operate and regulate. And that's not a good thing for anybody. So you got to make sure you're doing your due diligence on the market. Last thing I'll cover on this slide on asset classes are the rewards for mobile home parks. And that's stable cash flow. They are extremely affordable, and affordable housing right now is almost impossible to find. It's almost an oxymoron. But mobile home parks are still the one place where you can call it affordable. You can rent a lot, or a pad is what they call them, for a few $100s a month. Obviously, the home is your responsibility to bring the home or to own the home. But where else can you live for less than $1,000 a month and still get access to clean, affordable living? It's far and few between. So there's still a lot of demand, which means they can provide steady cash flow because these things can fill up if they're well taken care of. There's land appreciation, of course. You're not going to get the depreciation on assets like you would in multifamily and some of these other asset class, but you're still getting land appreciation. The land is going up in value over time. And then you've got the option for ancillary income. So just like multifamily, where you can charge pet fees and other fees like that, there's different fees you can charge in the mobile home space for different amenities you can potentially add to the park. So the question you need to ask yourself, that was a lot. That was kind of a heavy slide here, is which one of these assets aligns with your personality? Which one do you like? And then which one aligns with your investing thesis when it comes to risk and reward? We'll talk more about me and my preference here at the end, but here at Headway, we're really bullish on multifamily. We're really bullish on car washes. We also like the self-storage and industrial space, but at the moment, we're not sourcing any opportunities there, but it doesn't mean we never won't. We just want to make sure we do our due diligence and have an expert on our team before we take those types of opportunities to our investors. But these all provide different risks and different rewards. You just need to ask yourself which one's right for you. All right, so let's move on and talk about building your team, right? How do you build your team of sponsors? How do you build your team of professionals so that you can go out and invest in these projects, right? There's a saying in our industry that you don't bet on the jockey. You bet on the jockey, not on the horse, right? So what that means is your team is very important and the people you work with are very important, not as much as the asset class. So while we were just spending, you spent 20 minutes talking about asset classes, which are really important, what's really more important is your team and who you're actually partnering with, the jockey that's actually driving the ship that's riding the horse, so to speak. And this is a list of people that I believe every passive investor needs on their team. The first one you'll see on here is a CPA. And I'm going to highlight that it's not any CPA. So I come in contact with a lot of investors in my position that have a CPA, but their CPA knows absolutely nothing about real estate. It's very, very common. I would highly recommend that if you're getting into real estate, whether it's residential or commercial, active investing or passive investing, you need to have a CPA on your team that understands real estate. There's specific codes and tax laws and different things that not every CPA knows. And as we all know, the tax book is massive. The code book is massive. Not every CPA is going to know everything about real estate, and that's okay. They probably have their own niche that they're really good at. You need to make sure you find a CPA that works with investors, that works with real estate investors particularly, and understands how to leverage the tax code. Otherwise, you're not going to be able to reap the full benefits of your investment. Really, really important. The second thing you're going to need is a deal sponsor. A deal sponsor is just the active partner that you are partnering with, the company or the firm you're giving your money to invest into the project. Headway Capital is one of those options, right? We are a deal sponsor for multifamily and car wash and debt investment opportunities, but there are other sponsors out there, right? If let's say you love mobile home parks or you love self-storage and that is where you've decided you want to hang your flag, where you want to get started, you need to go find a sponsor for mobile home parks who only focuses or mostly focuses on mobile home parks. Or you need to go find a sponsor for self-storage who mostly focuses on self-storage or only on self-storage. You want to invest with experts, right? You want to go out there and find those deal sponsors. And the best way to find deal sponsors is by networking, going to real estate investment events, going on Google and just typing in, mobile home park investment, self-storage investment. Go on Facebook, type in mobile home park investing, self-storage investing, and try to see if you can find some sponsors with a track record, with experience, who have been in the game for several years, who have a successful record, and get on a call with them, network with them. We'll talk about the steps to gain access here in a minute, but you want to find credible sponsors. They're not that hard to find. It's not as easy as some of these other things, but you can find them if you talk to enough people, if you do enough networking, and you do enough research online. There are definitely options out there. The third person I believe you need on your team is a strong financial advisor, right? Most of the people that are investing in these projects, they're very successful professionals. They've got a higher net worth. They make a good income. It's always smart to have a financial advisor on your team. And it's important that you have a financial advisor, in my opinion, that believes in the power of real estate. If you have a financial advisor who tells you real estate's a dumb investment, it's risky, you should never invest your money in real estate, well, you got to ask yourself what their motivation is. If they're collecting fees off of your AUM and that's all they care about, not necessarily the health of your long-term portfolio and you building true wealth, then you got to ask yourself, is that the right financial advisor for you? And maybe you need to add a financial advisor and move some of your AUM over to a second firm that believes in real estate. We believe in diversification. We will never tell you here at Headway, sell all your stocks, get into real estate. So, liquidate your 401k, get into real estate. We believe in diversification. Real estate should be a part of everyone's portfolio in one way or another. And I'm not just talking about REITs. I'm talking about private investments, right? Private real estate investments. So find yourself a financial advisor that believes in the power of private real estate investments. They like this asset class and they know that allocating a percentage of your portfolio, whatever makes sense for you, could be 15%, could be 20%, could be 25%, and the rest of it can be in more traditional investment vehicles. That's the type of person you want to find. A real estate mentor, so somebody who can help you or that has experience investing in real estate. I always recommend that you find yourself somebody who's experienced. And I'm not necessarily just talking about the deal sponsor. And it doesn't have to necessarily be a coach or a paid mentor. You just want to have somebody on your team that has invested in real estate before that can give you some feedback on the opportunities that they're seeing and give you some feedback on strategy, right? So maybe you've got a friend who's privately or passively invested in real estate before. Talk to them. Maybe you've got somebody who was in residential real estate who transitioned over to commercial. Talk to them. Maybe you want to pay a mentor or a coach to learn more about commercial real estate. Have that conversation. We don't offer coaching or mentorship services here at Headway. So there's no conflict of interest here, but I will tell you that a really good real estate mentor is worth their time, worth their energy, and worth the money you spend on them to make sure that you're just getting in good investments. So try to find a real estate mentor. We're always happy to have conversations. And part of the reason we provide this free education to you on these webinars is because we want to provide you with some guidance and some education so you can be smarter and make smart investments. The last thing I would say is I would say more optional, but a lot of our investors take advantage of it, is to find a self-directed IRA custodian. So we're going to put out some content here in the coming weeks. You should find it available on our website about investing through a self-directed IRA. If you're not familiar with that, you're not sure what it is, that's okay. We're going to be providing some education around that. But if you have an IRA or a 401k and you want to make it, and you have the opportunity to transfer it and put it in a self-directed IRA with a custodian, you can actually passively invest in these private investment offerings that Headway has and that any of these other sponsors have through your IRA, through your self-directed IRA or self-directed 401k. It's a very powerful investment vehicle. It allows you to put your money to work in things that you choose to put your money in and work in. So definitely somebody I recommend you have on your team. There's some great custodians out there. There's a few good firms out there. Whether you're investing with us or with another firm, you can feel free to reach out to me. I'm happy to make some introductions so you can meet some of these self-directed IRA custodians. And I made this last comment on here, and I'll make it here again, but a strong team leads to a higher likelihood of success. If you're trying to do everything on your own, you're going to drastically lower the chances of you finding success. Bring these people on your team, right? Have a sponsor who wants to help educate you and make sure that your capital is protected first and grows second. Have a CPA on your team that understands how to take care of the tax benefits that come along with these investments, and a financial advisor as well. Have people in your circle that are doing what you're doing, whether it's a mentor or other friends or family members that have invested passively in real estate, for guidance. And then make sure, if you plan on using a self-directed IRA or self-directed 401k, that you have a custodian that you have an account set up with and you're ready to transfer funds over. Because as I mentioned, these deals move very fast. You don't want to wait to the last minute to have that conversation. All right. Third slide here, before we get to the last one, is how do you gain access to these investment opportunities? We've covered a couple of things here, right? We talked about picking an asset class. We talked about building your team. We talked about, and now we're going to talk about how do you actually gain access to these, right? How do you actually get an opportunity to invest, right? So here are the steps you're going to follow. So once you find that sponsor, on the previous slide, we talked about finding a deal sponsor. Once you find that sponsor, here's what you're going to do. So you find a private sponsor, a lot like Headway Capital or Headway. We're happy to talk to you, right? You're going to complete an application to invest. Every sponsor out there is going to have some sort of approval process that you're going to want to go through. Well, why is there an approval process? Why is there a qualification process? Well, we want to make sure that we're working with people that are qualified to invest. We work with accredited investors only. So all of our offerings are 506C offerings, 506 Charlie offering, which just means from an SEC regulation standpoint, we work with accredited investors only. Accredited investors, somebody who has made $200,000 if single, $300,000 or more if married for 2 out of the last 3 years, and or you have a $1 million net worth. So that's what the definition of accredited investor is. You have to complete an application to make sure you're qualified from a net worth accreditation standpoint. And then we also want to make sure we work with people that are aligned with our business plan. Not every sponsor is for every investor. You might have a conversation with me and feel like Headway is not the best fit for you, but you might have a conversation with another firm and love them. Well, that's okay. It's not going to hurt my feelings. We want to make sure you're working with somebody you know, like, and trust, and somebody you feel like you have good synergies with, and it's going to be a good fiduciary of your capital. So you want to complete that application, and then you always want to schedule a call. I personally would never invest with somebody I've never spoken to. I would never wire somebody $100,000 that I haven't had a phone call with, at least. So you always want to make sure you have that discovery call. You want to make sure you ask questions about them, their personal background, their current investments, their previous investments, their track record, their team, everybody that we kind of went over here on the previous slide. Make sure they've got their team built, and you want to do that qualification call. They're qualifying you and you're qualifying them, right? They're going to make sure that you're the right investor for them, and you have to make sure they're the right partner for you. As I mentioned, review their track record, ask for it. If they don't have it, that can always be something you want to talk through. But every good sponsor is going to have some sort of documentation on their track record and previous investments. If you're approved and they say, hey, we think you're a great fit, we'd love to invite you to join our private investors club or our whatever group or list that they have. You're going to then gain access to their private offering. So if you have a phone call with me or somebody from my team, for example, we'll have a quick, it's usually a 15 to 30 minute phone call, depending on how many questions you have. We'll check your accreditation status by asking a few questions, and then we'll get you access to our private investors club, in which you'll get a bunch of collateral. You get access to some exclusive collateral. You'll get access to our investment opportunities. And then when they finally come open, let's say we have an investment opportunity, you're going to get first access and access to look at it first and submit your commitment first. So you can invest and you can be one of our investors, right? The one last comment I'll make is you really want to make sure you do these steps before an investment opportunity opens, because move quickly when deals are open for an investment, because they fill up quickly, right? It's not uncommon, as I mentioned, that a deal could get filled in 24 to 48 hours, sometimes less. Some of the bigger deals might take a couple weeks, but before you know it, time flies and you're going to get that email saying, sorry, the deal's been closed. You missed out on the opportunity. We don't want any of our investors to miss out, although it happens all the time. I don't like taking the phone calls where somebody says, hey, Brian, I'm ready to invest. And I say, sorry, we closed it last Friday. You missed out. I sent you a text. I left you a voicemail. I sent you an email. You never responded, right? I hate doing that. But it happens because people don't move quickly. It's really important that you have a sense of urgency and you at least submit what we call a soft commitment. A soft commitment will allow us to hold your spot. It'll give you the opportunity to review the documents, look at all the legal paperwork, and then make sure you wire your money. It gives you that short window of time. If you don't submit your soft commit and you try to come in at the last minute, well, there might not be a spot for you and it might be full and you might have to go on the waiting list, or you might miss out completely. So go through these steps, connect with me or connect with another sponsor, fill out an application, have that phone call, get on their list so that you can be ready to invest when the time comes. This is how you gain access to investment deals. All right, wrapping up here. This is the last slide here. We got a few minutes left before we take Q&A. Is how do you quickly analyze a deal, right? So you're on this investment list. You've picked an asset class. You've got your team. You're now seeing these investment opportunities. And now you're asking yourself, well, how do I know if it's for me or not? How do I even know it's a good deal or a bad deal? Or more importantly, at least when you're getting started and you're new, how do you quickly say yes, that I want to go and actually look even further? It makes sense to me. I'm interested in investing, but I need to do more homework. Or how do you just quickly say, no, thank you, on to the next one. I'm going to respectfully decline this time. Just keep me in mind. I'll take a look at your next deal if it makes sense for me. The goal is to be quick. Again, I'm going to keep reminding you that quick, right? You want to say quickly, yes, I'm interested. Here's my soft commit. I'm not 100% in, but I'm very interested. And then I'm going to say, no, thank you, right? Here's a 7-step filter to run through all your deals. These are how I look at deals personally when I'm passively investing. And I've passively invested in several deals over the past several years. This is the exact same process that I use, right? So first, you're going to look at the target market. What market is the project in? And by market, I just mean city, right? So city and location are different. We'll get to location here in a second. But we're talking about what city, what suburb, what MSA is this project in? Is it in Houston, Texas? Is it in Dallas, Texas? Is it in Charlotte, North Carolina? Is it in Columbia, South Carolina? Is it in Tampa Bay, Florida? There's so many markets out there, right? What market it is in, and is it in a stable or growth market? I would highly discourage any investor, unless they like taking more risk, to invest in a declining market or to invest in a market that is very stagnant and has been slowly seeing negative growth over the several years, right? We like investing in growth markets that are either already stable, that have been stable for a long time and have no reason to change, or that are actively growing. They're seeing a net population increase over a 5 and 10 year horizon, right? So always make sure you look at the market. This first one, especially the first two, or I can say 95% of the time, I pass very quickly because I look at the target market and I look at the location and I say, thank you, no, thank you, right? So the second part is location. This is very specific. Where is the property located? I ask for the address, send me the address, right? Oftentimes it'll be on there, but if you don't see the address, ask for it, right? Is it in an A class area? Is it in a B class area? Or is it in a C class area? There's nothing wrong with either one of those. You just have to understand the risks involved, right? C class properties are going to have better cash flow, but they're going to be harder to operate, right? So there's more risk, there's more execution risk involved. B class properties are in the right down the fairway. They're a nice blend between risk and reward, in my opinion. And then there's A class properties. They're going to have lower returns. Instead of having that 7-8% return, they might have a 5 or 6% return, right? But they're less risky, right? They're in great areas. They're often new construction or newer construction. So you have to ask yourself, where is it? What's the location and what's surrounding that area? Where is it at? And very quickly, you can eliminate a lot of projects just by looking at the market and the location and saying, I don't invest in, say, D class areas. I have investors send me projects all the time and say, hey, Brian, I'm an out-of-state investor. Somebody send me this deal. It looks amazing. Can you look at it? And I say, send me the address. I don't even want any of the financials. Send me the address. I type in the address on my phone and I really quickly tell them exactly why they don't want to invest in that market, right? It's a really bad D class, F class, whatever you want to call it. It's just an area you don't want to be in, right? Very unsafe. So you have to make sure you're checking that. Some people like those deals and they like the risk involved because they're high risk, high reward, but they're not for us here at Headway. Asset class is the other one. Is it an asset class you're interested in? We talked about earlier about picking your asset class. If you're a multifamily investor and that's the only thing you want to invest in, or you're a multifamily and say car washes, I always recommend picking 2. Personally, I like to stick to 2. Is it one of those, right? So if you say, hey, I love multifamily and I love car washes, and then I send you a hotel deal, are you going to look at it? Doesn't mean don't, but you need to ask yourself, is it an asset class you're interested in and do you understand it? You should never invest in something you don't understand, right? So make sure you understand the asset class first. Value add. We believe in investing in projects that have a value add component. So that doesn't always mean that they're old and need to be renovated. It could be a part of that. It might mean there's an operational value add component as well. But the real big question when it comes to value add is there an opportunity to increase the NOI, which is the net operating income, right? Can we make more money? It's the easiest way to think about it. If there's not a value add component, you got to ask yourself, well, why are we investing in it, right? There's got to be some other reason besides the lack of a value add component. That's got to be really compelling for me to be interested in it. But we like value add opportunities. We like to go in and improve operations, improve the project cosmetically, improve the tenant base. And that's how we're making our money. That's how we make our money. That's how investors make their money. Management. Who's managing the asset post-closing? This is a really big, important question you need to ask. Who is going to manage this asset once we're actually closed? If there's not a strong manager in place, and I'm not talking about the manager sitting in the office, I'm talking about the property management company. Here at Headway Capital, we use Headway Properties. We own the management company for all of our assets here in Houston. Well, if we were to hire, let's say we were to go out of state and we hire a third-party property manager, well, there's nothing wrong with that. But you want to make sure that the manager that we've chosen to use is somebody who's been in the market, somebody who has other assets in the market, and somebody who's experienced. If they just started their company last year and this is their first property in that market, not a good idea. You're taking a ton of risk in that. You're probably going to pay for it in the sense that you're going to get much lower fees. They're going to be super cheap, but you're going to pay for it one way or another on the back end if you have problems and they don't have the right systems and teams in place. What is the business plan? Is the business plan feasible with the team, right? So if you see a project and you look at the business plan, does it actually make sense, right? Does it make sense what they're trying to do? They're trying to renovate units. They're trying to improve tenant base. Or does it seem kind of crazy and far-fetched, right? Do they have the right team in place to actually make that happen? And is there a strong business plan? Is there a strong story on how we're going to add value to this property? Really important. The last thing I'll make a note on here is basic numbers. Now, we could spend a whole hour talking about underwriting and all these other metrics, but kind of starting from the top is, what is the entry price? What are we paying for the property? In multifamily, we often talk about price per unit. So you might hear somebody say, it's a $10 million project and we're paying $100,000 a door, right? So you might hear that very common. And the more and more deals you look at, you're going to get much better at knowing what market rate is and where there's a discount involved, right? So if you know the last 5 C-class properties you've looked at are all $100,000 a unit, and I show you a property that's $90,000 a unit, well, you're going to know that it's under market, right? Which is good, but you also have to ask questions. Well, why is it under market? Is it in a bad area? Is there some story here that I need to know about? So what's the entry price? What's the exit sales price? So what are they planning on selling it for? Again, is that feasible? And really where you're going to find that out is if you're looking at the NOI and you're looking at the exit cap rate. So we'll talk about that in a second. What is the entry cap? So the entry cap is just, what is the cap rate that's being paid upon acquisition? Now, that's not always super important. It's a part of the process, of course, but a lot of the deals that are heavy value add might have a slightly lower compressed entry cap, but it's important that you at least know what the cap rate is. And the reason being is you really want to look at what the market exit cap is. What are deals trading for in that market? So let's say, for example, you're in a C-class property in Houston, and the exit cap on that type of property right now, based on market valuation, is say a 6 cap, right? So if you know that market rate is a 6 cap, because all the other deals you've looked at have been 6 caps, and you've maybe talked to some people in your circle, right? Talk about building your team, and they were talking about Houston being a 6 cap market for C-class products. Well, if you're looking at my deal and my exit cap is a 4.5 cap, well, that's a big problem. Lower is bad. I am overshooting what I think I can sell it for. And I think I'm creating so much value that somebody's going to be willing to pay tremendously amount for it. What you typically want to see is what we like to put is a 50 basis point for 5-year hold, 50 to 100 basis point spread on the entry and exit cap. So if I buy it at a 5 cap, I want to see an exit cap at a 6 cap. If I buy it at a 5 cap and I see it exiting at a 5 cap, doesn't necessarily always mean it's a bad deal. You just want to ask questions about the exit cap and how you got to that assumption and why you think you're going to be able to sell it for the same cap rate you bought it at. A lot of markets are very different. Dallas is very different than Houston. Dallas is way more of an attractive market. So the exit caps in Dallas and the spreads are much thinner than the exit caps and the spreads in Houston, right? So really, really, really important that you look at these basic numbers. So again, these 7 filters are how I run myself through things. What's the market? What's the location? Is it the asset class I'm interested in? Is there a value add component? Who's managing it? And what's the business plan? And what are some of the basic numbers? What are you buying it for per door? What's your entry and exit cap? And then I'm very quickly able to say yes or no. All right. So once you've done all that, when you're ready, you have to invest, right? This is when you actually have to take a leap of faith. You have to take a leap of educated faith, right? So you went through this whole process. You now have to decide whether you're investing in the project or not. So when you're ready, you have to invest. That's the one thing that we see from a lot of investors is they're standing on the sidelines, and months, years pass and they never invest. And they end up missing out on opportunities to generate cash flow, to build their portfolio and to build wealth as well, right? So if you find a good deal and you've looked at lots of deals and you feel like this is a good opportunity, you have to just invest. So it's something to keep in mind is you eventually have to take that leap and take action. So I want to leave you here today. Let's jump into Q&A, but some questions for you to ask before we jump into Q&A is, what are the 1 or 2 asset classes that you want to focus on? You need to have that answered here after you get off this webinar. Think about it. What are the ones? Go back. I'll send out this recording. What are the asset classes that you're really bullish on? There's some other asset classes that I didn't put on there. I didn't put hotels on there. I didn't put triple net retail on there. Office is not a great asset class right now, but it is another asset class, right? So there's lots of asset classes. Figure out the 1 to 2 you want to focus on. Is your team built out? If somebody on that list that I put out is missing, you need to find them, fill the hole. Have you registered with a sponsor to invest, right? Have you got on our private investors list? Have you filled out an application to invest with Headway? If you haven't, you need to do so. You're not going to have access to these opportunities if you don't. And do you know how to analyze a deal quickly so that you cannot miss out when the time is right? Can you quickly say yes, or I'm interested, send me more info. I want to I want to hold the spot because I like this deal and I think I'm going to invest, but I just need to look a little bit more. Or am I a hard no, thank you. I don't want to waste your time and I don't want you to waste my time. This is not for me. Let's move on to the next one. So you got to be able to do that quickly. Real quick, before we jump into Q&A, I want to talk about a current investment offering we have. We launched this last week. It's opening up for investment next week, wrapping up some of the legal docs, but we have the Headway Capital Debt Fund. If you're looking for cash flow right now and you want to invest into something that just generates monthly dividends and you know that these CD rates that you're seeing at banks are not going to last, we offer the Headway Debt Fund. This is a debt fund. It just provides dividends every month. There's no upside. There's no equity. There's no tax benefits. It's strictly cash flow. The investment minimum is as low as $25,000. Anywhere from $25,000 to $99,000, you get a 6% preferred return. Anything over $100,000, there's an 8% preferred return. And this is a debt fund. It's a hard money fund. We're loaning out money to investors. They're paying a premium on that money. And we're able to, of course, keep the spread and pay our investors. And of course, we are the manager, so we take a fee as well. So if you're interested in the Headway Capital Debt Fund, you're looking for passive cash flow, you like real estate, you want to diversify your portfolio. And the great thing about the Headway Debt Fund is it's liquid. It has a 90-day liquidity window. So if you want to pull your money out after 90 days, you can. You let me know. Say, hey, Brian, I've had my money in there for 9 months. I think I'm going to need it back. I got this thing I'm working on. You send me an email. I promise I'll get your money back in 90 days or less. So you're getting that monthly cash flow. And if you want to pull your money out, you can. I just need 90 days to pull it out. So it's a great opportunity. And it is for a 506C for accredited investors. If you want to join our private investors club, you can request an invite, fill out that application here on the right-hand side, scan that QR code. If you want to schedule a call with me and discuss more about partnering with Headway, about investing with Headway, about joining our Headway family and partnering with the other 400 investors that have partnered with us over the years, scan that QR code on the left, get on my calendar. I'd love to talk to you or somebody from my team so we can learn more about you and see if we're a good fit for each other. So let's move on and let's open up to Q&A. I see lots of questions here in the Q&A box. I'm going to run through these. And I also got some via email that's a couple of people sending me that they wanted me to answer on air because they said they weren't going to be able to make it, but they would watch the recording. Let's see what we got here. What is your favorite asset class and why? I think I kind of mentioned that earlier. I really like multifamily. I'm bullish on multifamily. I think we've seen excessive price increases over the last several years. And we actually have not acquired a lot of multifamily in the past couple of years. Most of our assets were bought between 2018 and 2020. So a lot of the overpaying in 21, 22 that happened, we unfortunately, or fortunately, I should say, didn't acquire a lot of deals. And the ones that we did acquire, we felt like we bought them right. We had interest rate caps on them to protect ourselves and our investors as well. So we're licking our chops over here. We're ready for more multifamily deals. We've got a property management company. We're ready to hire more people. Our team's ready to manage more assets, and we feel like there's a prime opportunity coming for what we'll call distressed assets, which means assets that are either being very poorly managed where the seller needs to sell, or they're in financial distress. They overpaid. They bought in 2021. They bought in 2022. They're running out of cash and they need to sell to exit, or the bank's going to foreclose on them. We feel like that opportunity is coming. So keep your eyes peeled. We are on a weekly basis looking at multifamily deals. We just haven't seen one that makes sense for our investors yet. We like buying properties at a discount, and that we like them when there's meat on the bone. So multifamily is definitely my favorite. I also really like industrial as well. I think it's a great asset class. And of course, I love car washes as well. I think it's a very unique asset class. How do you find more sponsors? Oh, that's a great question. So I covered this a little bit earlier, but I think you need to put yourself out there. If you're not talking to people, you're not going to find other sponsors. So a sponsor, again, is a private equity firm that you can invest with, like Headway. If you want to meet more sponsors, I would recommend you go to real estate events. So if you just go on your computer, search, pick an asset class, self-storage real estate event in my area, multifamily real estate event in my area. Go to these conferences, go to these events, and shake hands with active sponsors and ask smart questions, right? The other thing you can do is put out feelers. Ask anybody in your network if they've privately invested with any real estate, in any private passive real estate deals. See if they have any recommendations. They're out there. But you got to ask. If you don't ask, you won't find out. And then I would also encourage you, as you're building your team, we talked about having a CPA. We talked about having a financial advisor. They might be able to make some introductions. I wouldn't say refer you because they legally can't do that, but they can make some introductions and they could say, hey, these are some guys that we know. Some of our other clients use them. Here you go, right? So you can always ask as well. Ask your team. They can make some recommendations or referrals, I should say. How long? Let's see. How do you know if a sponsor is credible or experienced? That's a great question. So I would always ask when I talk to a new sponsors, I always want to have a phone call with them, and I want to ask about their background. I think it's really important to ask about where they came from. Are they educated? Did they go to college? What were they doing before real estate? The funny thing about real estate is most real estate investors, did not start in real estate. They started somewhere else. So I like knowing their background. I want to know their story. Do they have a family? What motivates them? What makes them tick, right? It's really important that I get to know them as a person. The second thing I want to ask is I want to see their track record. I want to know what types of deals they've done in the past. How are they performing? And then if they're not performing well, that's not always a bad thing. It's just about seeing if they're transparent. Here's the reality. If you invest in if you buy 100 buildings, let's say we buy 100 multifamily deals or 100 single family deals, you're not going to make they're not going to all be home runs. I'll just put it like that, right? So not every deal can be a home run. Sometimes you're going to have challenges, and you're going to have to own those challenges and explain to your investors, like, hey, we bought this project, and we promised a 10% return, but we're only able to pay a 6 or 7 or whatever the number is, right? And you got to be able to own that and say, hey, here's why it didn't go well. So I like sponsors that are transparent about not only their wins, but also any potential challenges they had along the way. And just ask them if they have what we call like a credibility book or a track record book. Oftentimes, a good credible firm will be able to send you either in an email or in a PDF document or digital file. They can send you their history and their background with more details. Let's see what else we got. How long has your management team been investing in multifamily? That's a great question. So Sid and Anam got into multifamily as passive investors, as I mentioned, in 2016, 2017, and then started investing in multifamily as the lead sponsor, as the operator, where we actually buy the buildings and manage them with investors in late 2017, at the beginning of 2018, right? 2018, I guess you can say, is the best answer there. But they were passive investors first. So they gave their money to people like Headway to learn about the process so they can eventually grow into that active role. They knew they wanted to be an active investor and to own their own company one day. And the best way to learn is to passively invest with somebody who's already where you want to be, because you get the emails, you get all the communication, you see all the financials, you get to ask questions, you get to be involved on the property tours and going to check out the assets, right? So you can be a very, what we like to call a very active passive investor. And that's how they learned, right? And then they started their firm in 2018, right? So going a little over 5 years now. So we've been around for a little over 5 years. And that's also when we started Headway Properties, which is our property management company. So great questions. Let's see what else was. What does it take project to get approved? What does it take to get approved to invest in your projects? Great question. So what that entails is essentially filling out our application, which you talked about, having a phone call with me, and I'm going to ask you some very specific questions about, again, saying your background. Tell me about your history investing in real estate, your history investing in any type of alternative assets. I'm going to need to know about your accreditation status. So do you meet the income requirements or do you meet the net worth requirements? And then I'm going to ask about your investing strategy. Are you looking for cash flow? Are you looking for equity appreciation? Are you looking for something else? And to make sure that there's synergies. If you come to me and say, hey, Brian, I'm looking for a 35% cash on cash return, I'm going to tell you, unfortunately, real estate investments don't provide 35% cash on cash returns. We're in this ballpark. Sorry, we're not a good fit for each other, right? So we want to make sure we're in alignment with the type of returns that we provide and also the type of experience we provide and what type of opportunities we provide. If you tell me you love mobile home parks and you want to invest with Headway into mobile home parks, well, I'm going to tell you that we don't do mobile home parks. We don't invest in mobile home parks. So we're not the best fit for you. So once we have that call, if we are a good fit for you, I'll put you on our private investors club group. You'll get some exclusive emails and invites from us for events that we host, and you'll get some more details about our firm. You get our welcome packet. And then once you're on our list, you get exclusive access to these opportunities, and we stay in touch with you regularly. It's my job to make sure that we're calling, texting, and emailing you regularly, not weekly or monthly. We don't bother you like that. But I'm going to check on you quarterly or semi-annually. Just reach out. Hey, how's it going, Dave? How's the family? Invested in anything lately? What type of opportunities are you still looking? Are you looking to invest right now? Just want to touch base, quick 10 or 15 minute call, make sure we're on the same page. my goal is to provide that white glove service, right? So you'll get that treatment from us. That's my job. How much is your minimum investment typically? Good question. Most of these investments, whether you're investing with our firm or you find another sponsor, it's very rare that you see something below $50,000 per project. That's pretty rare. Most sponsors you're going to see today are in the $75,000 to $100,000 range. We're very similar. So we stay in that 50 to 100 range. It really depends on the size of the deal. If it's a very, 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 very large raise, we often go with a higher min just because it makes it a little bit less of a challenge, I should say, to raise that minimum, to raise the equity if we're having a higher minimum. So 100,000 is our average investment. So out of all of our investors, if you look at our average, it's a little over 100,000. Most people decide they want to put 100K in. So that's the question there. Is there minimum population? Great question. It says your 7-step filter is very helpful. Is there a minimum population for a city to invest in? That's a great question and something I did not cover. So on the previous couple slides, I was talking about markets. I was talking about cities and locations and target markets. I would highly recommend that you try to stay in primary or secondary markets when it comes to commercial real estate. And that's my opinion. Some people will disagree, and I'll tell you why. So we won't look at anything that doesn't have a population of at least 250,000 being on the low side, ideally 500,000 to 1 million or more. Obviously, Houston, major metro, 7 million people in the MSA. Plenty of people here. There's no risk of population decrease, I would say, from 7 million to like 1 million, right? That would take decades. But it's very risky, in my opinion, to invest in a project that is in a city that, say, maybe only has 10,000 people, 50,000 people, right? Because if you've got a 100-unit apartment complex in a city that only has 20 or 30,000 people, well, there's arguably not enough density. There's not enough tenants there to keep that property full. And the second thing that I think is most risky is that you have a hard time selling, right? It sounds great when you can buy a property out in some city you've never heard of and you're paying 70 cents on the dollar. You're high-fiving your guys because you got it for a super cheap price. Well, you get what you pay for. It might be a great investment while you're holding it, where you might have a really hard time selling it for what you thought you were going to sell it for, depending on the market, right? So it's really important that you invest in markets that have strong population growth and that already have a good base, as I like to say. So I like 250,000 as sort of the baseline, as the baseline number. So great question. Let's see what else we got here. Can any CPA help with these types of investments? Technically, yes. I'm not a CPA, so ask your CPA. But as I mentioned earlier, I have talked to, when I was looking for a CPA, I probably interviewed 5 or 6, and I got down to about 2 who I could tell actually knew what they were talking about when it came to commercial real estate investing. They worked with a lot of passive investors. They knew what I was talking about. The second I opened my mouth, they knew exactly what I was doing. And they're like, oh yeah, we work with passive investors all the time. They invest in this, and that. And this is how we structure it. This is how we work with them. Okay, cool. Awesome. Let's keep talking. If you start bringing up passive investing and K1s and different things of that nature, and they look at you like you're crazy, you probably aren't talking to the right CPA, right? So definitely make sure you're doing your due diligence. I'm sure any CPA will tell you, yes, they can help you, but I like to work with experts. So I would recommend you find a CPA that really, really understands passive investing. Maybe they're a passive investor themselves. My CPA is a passive investor himself and works with a lot of real estate investors, both active and passive. I love working with CPAs like that. Let's see, any other questions here? I think we got through all of our questions. So I appreciate everyone for being on this. It's exciting to see so many people interested in getting into their first real estate investment. We're excited to be here and help guide you along the way. As I mentioned, if you're interested in investing with us, shoot me an email, brian@headwaycapital.us. You can also go to our website, headwayinvestment.com, fill out the form to hit the invest now or apply to invest button. Fill out the form. Somebody from our team will reach out to you. And if you're interested in any of our current offerings, such as the Headway Debt Fund, again, shoot me a message. I'm happy to chat. But I want to thank everyone for attending Legacy Wednesdays. We will be back next week with our next topic. Until then, happy investing.